Hey everyone, my name is Dino and this is Wall Street Wannabe, a video series that explains the ins and outs of Wall Street in plain English. In today's episode, I'll give you a high-level overview of what investment banks do. So, investment banks are institutions that help companies with some of the most important and complex financial decisions, such as raising money, buying and selling companies, or famously called M&A, or restructuring. And we're going to explore each one of these in a little bit more detail. In short, investment banks connect companies that need money with investors that have money. For example, say you're a CEO of a company and you need $500 million to build a manufacturing plant. Chances are you don't have that kind of money laying around, and you can't just call a friend and ask for it. So you would approach the bank. At that point, the bank would assess the quality of your company, the quality of your financials, and say, okay, we will work with you. We can get you $500 million. At that point, the bank goes to investors, says, hey, we have this new deal. It's a good company. They need money for manufacturing plant. And the bank would try to raise $500 million in smaller chunks from many different investors, promising them, for example, a 10% interest rate. So at the end of the deal, the company gets its $500 million. The bank gets the commission for taking care of all the paperwork, legal stuff. And then the investors eventually will get their money back, plus the interest rate of, say, 10%. Another major activity of investment banks is M&A, which stands for mergers and acquisitions. Or in plain English, it's just buying and selling companies. Now, imagine you're a CEO of a company. You have a decision. You can maybe sell your company to somebody else, or maybe you want to buy a competitor to combine the two companies. As you can imagine, these are very complicated transactions, and this is where M&A bankers step in. These are experienced professionals that will guide the company through this complicated process, making sure all the marketing materials look beautiful, all the legal paperwork is sound, all the financials are projected and make sense, and in the end, the main goal is that at the end of the transaction, everybody goes home happy. Finally, let's talk about restructuring. When the company can't repay its debt to investors, it faces bankruptcy and the shutdown of its operations. Now, these are unfortunate situations, and this is where restructuring bankers step in. Essentially, they're trying to figure out what could be done, who could get what, between the company and investors, and eventually try to give a second chance to the company in order to continue its operations as opposed to being shut down forever. So this is a quick overview of investment banking. There are a few more functions such as sales and trading and research that investment banks do, but we'll talk about them in another video. All in all, investment banks are essential for complex financial transactions. A lot of companies couldn't do this stuff on their own. And even if they could, banks can do it faster, better, and cheaper. So, even though the industry gets a bad reputation a lot of times, many people are often unaware of tremendous benefits that investment banks bring to companies that your daily life depends on. So thank you for watching, and I'll see you in the next episode.